On a custom manufacturing floor, hundreds of financial events happen simultaneously. Raw materials are pulled from shelves, machinists clock in for specialized tasks, and machines consume massive amounts of power to keep production moving. To correctly price a single unique product, accountants need a reliable way to capture every one of these scattered activities and route their costs to that specific item. This is achieved through job order costing. Job order costing is the systematic framework used to track and assign material, labor, and overhead costs to distinct custom jobs. In this system, financial realities are strictly governed by physical or digital artifacts. Every dollar recorded in the general ledger must be initiated by a specific internal operational document. This diagram shows the beginning of that document flow. A sales order from a customer acts as the ultimate genesis of the process. It dictates the issuance of a production order, which officially initiates physical work on the factory floor. Without these initial physical or digital triggers, accountants have no mechanism to track the start of a job or maintain an accurate ledger. The document flow creates the financial flow. Once production begins, we move from the physical factory floor into the clean environment of the general ledger to capture the incoming data. There are three distinct manufacturing costs that must be tracked for any job: materials, labor, and overhead. To capture these costs, we construct a conceptual architecture using three distinct reservoirs: raw materials, work in process, or WIP, and manufacturing overhead. The ultimate goal is to route the correct amounts into the center reservoir, work in process. This specific account serves as the financial representation of the job cost sheet for the item currently being built. Which reservoir a cost enters depends entirely on a strict rule of traceability. If a cost can be directly tied to a specific job, it flows straight into work in process. If it cannot be traced directly, it gets diverted to the manufacturing overhead reservoir. By building this specific T-account architecture, managers create strict checkpoints. This ensures no cost is lost or improperly assigned to a product before the job is finished. Before any routing of costs can happen on the ledger, the factory must actually procure the raw materials. This journal entry shows how raw material purchases are initially handled. They are recorded as inventory assets, with a debit to raw materials and a corresponding credit to accounts payable. Once in inventory, a materials requisition form is required to move parts out of the storeroom and onto the factory floor. This diagram maps exactly how that single document splits costs into two distinct paths based on traceability. The top path represents direct materials. These are items explicitly traceable to the specific custom job, so their costs flow directly to the job cost sheets, increasing the work in process account. The bottom path represents indirect materials. These are untraceable items used across multiple jobs simultaneously, like machine lubricants or cleaning supplies. Because they cannot be linked to one specific order, they are diverted into the manufacturing overhead account. We then translate this physical flow back into the strict language of the general journal. The material requisition document enforces accountability. If a material cannot be distinctly measured for one specific job, it cannot enter the work in process account directly. The same strict logic applied to physical parts must also be applied to the cost of human effort. The mandatory document that triggers labor cost routing is the employee time ticket. Workers use these tickets to log the exact hours spent on specific custom jobs throughout their shift. This schematic shows how the time ticket splits labor into the same direct and indirect categories we saw with materials. Traceable hours specifically worked on a custom product are classified as direct labor. The cost of those specific hours flows directly into the work in process account to update the individual job cost sheet. However, the wages of maintenance staff, factory supervisors, or janitorial crews cannot be linked to a single custom order. This indirect labor is diverted away from the job sheet and straight into the manufacturing overhead account. This journal entry locks in the distribution. Work in process and manufacturing overhead are debited for their respective shares of the labor, while salaries and wages payable is credited for the total amount. By strictly segregating labor at the time ticket level, Operations managers guarantee that a custom job is only charged for the specific work it required, rather than being unfairly penalized with the cost of general factory supervision. At this point, the manufacturing overhead account has been steadily collecting indirect materials and indirect labor. This account functions as a temporary clearinghouse, or holding tank, for all untraceable factory costs. Maintaining a functional factory requires a wide array of support costs beyond simple indirect parts and labor. The other overhead category captures these essential facility expenses. These actual overhead charges include sweeping facility costs, like factory rent, property taxes, insurance premiums, and equipment depreciation. This journal entry shows how these costs are captured as they are incurred. Manufacturing overhead is debited for the total, while credits are made to various payable accounts and accumulated depreciation. If the accounting system fails to capture these hidden facility costs in the overhead holding tank, the final product margins presented to executives will be inaccurate, obscuring the true cost of production. We now have an architecture where work in process contains the exact, actual costs for direct materials and direct labor, but the actual facility overhead is still locked in the holding tank. To finalize the job cost sheet and bill the client, a portion of that overhead must be extracted from the holding tank and assigned to the specific custom job. This demonstrates applying overhead. Accountants transfer an estimated amount from the manufacturing overhead reservoir into work in process, using a predetermined rate. Because this is an upfront estimate, the applied amount will differ from the actual costs flowing into the tank all year. This discrepancy between actual and applied overhead necessitates a mandatory year-end adjustment to reconcile the accounts. Applying an estimated overhead rate is a necessary compromise. It allows operations managers to price and ship custom jobs immediately upon completion, rather than waiting months for the actual facility bills to arrive. There is one strict boundary rule for this entire job order costing engine regarding non-manufacturing corporate expenses. Non-manufacturing costs, such as the salaries of the marketing team or administrative insurance, are never assigned to individual jobs. These period expenses completely bypass the inventory T accounts we have constructed and are expensed immediately on the income statement during the period they are incurred. From the initial sales order to the material requisitions and employee time tickets, every factory activity generates a document that triggers a precise routing of costs into the ledger. By rigorously forcing every physical factory document through this exact structural flow, businesses ensure that the final dollar amount on a job cost sheet is an auditable truth, ready to withstand any rigorous financial scrutiny.